we're going to wrap up an exciting night with just a little bit of a downer, okay? We got to get a little somber now and then. We can't all live in bliss for eternity. It's just not possible. There's going to be times where we're disappointed, and you see Starbucks down 1.5% after hours, and you're like, well, what the hey, man? On the bright side, I did verify, for Google, they needed to know when the company was founded. And, I just used my massive brain, clearly massive. That's why I'm assuming that's why my head's so big. But it could just be a big head just because it's big. But overall, stock down 1.5. We're going to see why. We're going to chase after an answer. We want to know. One thing to consider as we always look at the 1-year chart, almost shocking, the stock is up 18% in the last year. Now, some people might ask why that's shocking. To me, I find this shocking because the entire company itself, the entire business, completely just shut down this year. I mean, we're talking about 2020. Half the year, the company could not operate any stores. My gosh, we saw revenue declines of 40%. It was rough. It was rough last year. And the stock's actually up on the full year, which seems a little wild to me. I mean, that's my opinion on the matter. So you look at these numbers, they're worse than I expected. The EPS line is better than I expected. A net non-GAAP EPS of 61 cents beats by 6 cents, and a GAAP EPS of 53 beats by 5. Revenue, though, sitting at $6.7 billion, is down 4.9% year over year, is a miss by $170 million. Kind of disappointing. Store sales down 5% versus a consensus of 3.6, so not good there. America's down 6 versus a consensus of 4.2, and international down 3 versus a consensus of 1.3. So I think there's a lot of things at play here when you look at these numbers just off the top. We'll look more in depth, obviously, to them, but I think for a company like Starbucks, normally I wait until the end to say if the stock's worth taking a look at buying. I think for a company like Starbucks, I think there's a good reason why it's down. I think it got a little bit too big for its own britches. We're talking about this is a large deal, but it's trying to fit into a size small, but clearly it's a large right now. It's a venti, as they might call it at Starbucks. What's the large? Is that venti? Don't go to Starbucks. Sorry. As in, I am not a middle-aged female. So that's presumptuous of me. That's really rude. But yeah, I think it got a little bit too big for its britches. I don't think the recovery is quite fully there yet, but I think the stock's priced in as if it has fully recovered. So I think this thing needs to cool down just a little bit and probably stay stagnant for a little while. And I think it probably will, just because of the fact that this thing it's just a shocker to see this thing up on the year when still a year later we're still seeing a decrease year over year. The recovery it's happened. I mean, there's been a significant recovery, but they're not quite back to pre-pandemic levels, and that should be noted. So that's just one little thing to add on before this starts. The EPS hasn't climbed back up. The revenue hasn't climbed back up. But they are expecting for the next quarter, they're expecting U.S. comp sales stores to grow 5 to 10%, which is pretty crazy. And China comp sales to grow nearly 100%, which isn't a shocker because in China they couldn't do drive-thru, they couldn't do anything. They completely shut down the stores for quite a while. So to see that growth, I mean, it'll look pretty exciting, but it won't mean much if you're talking, really you want to compare it more to 2019 numbers than you do to last year's numbers. And a GAAP EPS of 36 cents to 41 cents. Not super exciting in terms of the EPS line for next quarter either. So for the full year, though, they're expecting EPS of 242 to 262 and global comp store sales growth of 18 to 23%. Now that will be some growth there. Consolidated revenue of 28 billion to 29 billion. That'll be the recovery we want to see. Now again, this year's numbers will be skewed. You'll see growth obviously because last year they were in the hole. So this year the numbers will look a little bit better. But all things considered, we're going to see some recovery supposedly next quarter. It's worth mentioning, but again, off their estimates, they didn't quite hit them this quarter, so who's to say they'll hit them next quarter? So worth mentioning, obviously. Average ticket price, though, was up 18 or 17%, which is a consistent thing there. Transaction growth down 19. It's been consistent. People aren't necessarily going in the stores as much. In some places, they're not open even still. So you need to consider that as a reason for it. We've had continued lockdowns in some areas, some cities, to where you can only do drive-through. And not a lot of people only want to do drive-through. And there's only a limited number of products they'll probably get through drive-through. No one's probably getting the bakery products if you're going to the drive-through. Just being honest, they're probably going to get just a coffee. And some people, it might deter them entirely from going when they know that drive-through line is going to be freaking 30 people deep. And we've all witnessed it. So that's how I know there is recovery in terms of people going there, because every line on the drive-thru is typically pretty massive. But again, I think we're not going to see full recovery until later this year. So that is one thing you need to consider about the stock. The stock itself, active membership in the Starbucks Rewards program rose 15% during the quarter. So people want to get rewards for shopping. They're loyal. It's loyal customers. That's what Starbucks does. They make loyal customers. So operating margin fell to 15.5% of sales versus 18.2% a year ago, and a 14.1% consensus, so a beat on that aspect, actually. We remained optimistic about our robust operating outlook for fiscal year 2021, says Kevin Johnson. So we'll see what that looks like. Their revenue consensus is right along, or their revenue estimates are right along consensus, and their EPS a little bit lower than consensus was. So nothing crazy though. It's right along right along tracks for the most part. So let's take a look at these earnings. We'll zoom in just a little bit for you, only a little bit, okay? Only a little bit. So Americas, we saw a 21% decrease in transactions and a 20% increase in average ticket, where store sales declined 5%, driven by 21% decrease in comp transactions in the U.S., and 19% increase in ticket. So that's where you're going to see everywhere. It's going to see a decrease in transactions, but an increase in ticket. You'll see it through the entire, every segment for them. Less people going there, but people are buying more there. So it is worth noting. The company opened 278 net new stores in the first quarter, yielding 4% year-over-year unit growth. Interesting stuff. That's quite a bit of growth. 32,938 stores at the end of this quarter. Pretty crazy. Yeah, that's pretty wild to me. It's a lot of net new stores, and obviously a lot of that you're going to want to see growth in China. That's what they've been talking about for a while. So a good thing is going to be to see the recovery there, and I think that's where this company will find its recovery is. It's going to be international this year really, and sooner rather than the U.S. will find it, in my opinion. So worth looking at. Obviously exciting stuff. So we saw the decrease here in terms of transactions and an increase in ticket. The store count finding an increase as well. Pretty cool. There's nothing really mega exciting out of this. We saw the guidance. We saw the guidance here. So the company is expecting China sales to be 27 to 32% growth in China, and approximately 2,100 net new stores opening, and 1,100 net new Starbucks globally. So interesting stuff. So yeah, and expecting 600 net new of those to be in China. As I've talked about, China's going to be what this company is kind of focusing on. So I do want to look at the balance sheet because it's worth seeing what this year's done to them, and how it's affected the company's balance sheet, because you'd expect negative stuff here. It is kind of hard to give a wager because it's only 3 months comparison, but we can see what this quarter did to them. Should be a little bit better than the quarter prior, but we'll see. Total current assets sitting at $8.3 billion versus $7.8. So you saw growth there, mostly in just the cash position, cash and cash equivalents. Total assets in general sitting at 29.9 versus 29.3. So a slight growth there, 600 million. Now total current liabilities sitting at 7.8 versus 7.3 of 30 months prior. And total liabilities in general are sitting at 37.8 versus 37.1. So there's not much fluctuation there over the last 3 months in terms of this balance sheet. But we do need to consider is this fact that this stockholder equity, really stockholder deficit, is going in the wrong direction. $7.9 billion deficit compared to $7.8 billion. So a slight increase in terms of the deficit. It's not exciting stuff. I'm not saying that the future's by no means bleak for this company, but I think the short-term future is bleak for the stock, in my opinion. It's still a good base. I mean, I have it in my portfolio. I'm not going to lie to you, but I wouldn't consider adding at these levels by any means. I think this stock has just somehow defied all odds in the fact that it's grown over the last year when I don't think it has any right to. It hasn't recovered to really pre-pandemic levels. It hasn't seen the recovery. I haven't had proof of the recovery yet. They've recovered quite a bit from where they were. Obviously, when you're talking about the second quarter of last year, you've definitely seen, obviously recovery since then, but I haven't seen recovery of pre-pandemic levels. That's what I want to see to give the stock the valuation it had before those levels. And right now, the valuation is out of this world. Market cap of 123 billion, which seems a little bit wild to me when you're talking about a company that's it's not buck wild. The company's annualized revenue is around 28 billion, obviously, on a good year. So it's not incredible valuation in terms of that, but the PE ratio is sitting over 130 because you've yet to see the EPS line recovery is a concern for me. So that's why I don't think the stock's necessarily worth it at these levels. Because I think it's going to go through a long period of stagnation. I really think it should, and I think it'd be fair if it did. I think it's just rising with the whole market. People have just, got into a habit of buying everything, and I think if we see a downturn in the market, Starbucks is probably going to face a little bit of a rough time in terms of the stock. You see it in the balance sheet that's not looking good at all. The balance sheet's looking pretty horrendous. The company's going to need a very good year to recover. This isn't going to be their 100% growth recovery year. I think they'll have to wait until next year to see a really good year where they can start recovering that balance sheet and everything of the sort. So keep that in mind when you're thinking about Starbucks. But yeah, that's what I got for you.